The Great Recession revived interest in some long-ignored theories of the business cycle, but many of them leave a little bit to be desired. But in the void of uncertainty about the crisis, some economists from smaller universities managed to get their voices heard as well. One group of economists had a message which echoed the message of Milton Friedman. If you want to know why the Great Recession happened, they said, we need to look no further than the Federal Reserve. This chart shows the federal funds rate from 2002 to 2016. And you can see clearly the times when the Federal Reserve changed its target for this rate. Those sharp turns are the changes, and the flat parts are where they kept things steady. In the years prior to the Great Recession, the economy was doing very well, and the Fed rightly focused on keeping inflation at bay. But when things turned the other way and the economy started to struggle in 2007 as housing prices fell, the Fed took action to stimulate the economy by easing monetary policy and lowering their target rate. They did this well in advance of big warning signs, too. This is where Bear Stearns failed in March of 2008, and this is where Lehman Brothers failed in September of 2008. So it would appear to most that the Fed was following the prescription of the new Keynesians and easing monetary policy just as the economy needed it. And those who thought the Fed acted aggressively here were perplexed as to why the Great Recession was still so bad. They thought this was contradictory to the theory, because the rapid shift to easing should have prevented a big downturn. This new group of economists disagreed. The theory was fine, they thought. The problem was that the Fed didn't act aggressively. They pointed to this critical moment here, the summer of 2008, when the economy was descending into the financial crisis, but the Fed held rates steady for months. They pointed back to the Great Depression, where a similar delay in action from the Fed was the decisive blow to the economy that sent it spiraling into the Depression. The Fed should have been continuing to lower rates through the summer, providing the liquidity to the market that might have in the end saved Lehman Brothers and the overall economy. And just like monetarists like Milton Friedman argued back when, these new market monetarists suggested that the Fed was prone to mistakes, and this was just another one of their blunders. The Federal Reserve is staffed with very smart people who have a genuine desire to keep the economy stable. It's a good institution with good incentives, but they have to take in a huge amount of economic data, such as GDP, levels of debt across different parts of the economy, inflation and all kinds of price indices, exchange rates with other nations, many different interest rates that cover things like business loans, corporate bonds, mortgage rates, and the rest, as well as market data from stock markets all over the world and fluctuations in the prices of critical resources and commodities like crude oil. Then they use complex economic models. Think of the Solo model we used, but with dozens more variables and equations that all must be balanced to analyze this data and weigh the trade-offs to determine what their target will be for the federal funds rate, as well as what methods they will use to reach that target. And these decisions have economic consequences for everyone, from major banks to ordinary people. It's a lot to process, and the market monetarists aren't trying to fire shots at the Fed when they point out these policy blunders. They're hoping to help them avoid those mistakes in the future. You'll remember that Milton Friedman suggested we solve this problem by turning monetary policy over to a computer, which would grow the money supply by the same rate every year, no matter how the economy was doing. Even Friedman eventually agreed that this was a little too simple to really work, but the new Keynesians, who took up the project of monetarism, recommended rule-based monetary policies like the Taylor Rule for all the same reasons. The market monetarists think the main problem with those approaches is the focus on interest rates. By choosing a target for the federal funds rate, the market monetarists argue that the Fed is looking backwards when it should be looking forwards, that lowering the federal funds rate reflects a correction for past monetary tightness, not an anticipation of future economic conditions. To turn the Fed's eye forward, they recommend a new policy target, the growth rate in nominal GDP. Nominal GDP, if you remember from Chapter 1, is the market value of all final goods and services produced within a country in a year. Importantly, there are two ways we can increase nominal GDP, which is usually reported as just plain GDP. We can increase the amount of final goods and services we produce, or we can increase their market value. In other words, we can have real economic growth, or we can have inflation, or both can happen at the same time, as usually happens. Economists often adjust GDP for inflation in order to get real GDP, so we can see what the real growth rate is. But the market monetarists see nominal GDP as a useful thing to target. Say we set a target of 4% growth in nominal GDP every year. First of all, that would help everyone set expectations for nominal wage growth. Nominal GDP is a measure of total income for a country, and so a 4% growth rate in nominal GDP also means a 4% growth rate in nominal incomes. But also, maintaining this target will call for counter-cyclical monetary policy. In a downturn, growth is low, and the market monetarists are suggesting that the Fed ease monetary policy to make up for all that lost real growth with inflation. In other words, if a recession happens, the goal is to reinflate the economy to get things moving again. This is in contrast to the Fed's policy of having a target for inflation and unemployment. The Fed tries to maintain 2% inflation at all times, but this can be in conflict with the goal of full employment during a recession. Remember, there's a short-run trade-off between inflation and unemployment. So when a recession pushes unemployment up, market monetarists want the Fed to push inflation up to counteract it. In this way, the Fed's target for inflation would be whatever it takes to get nominal GDP to 4%. And if inflation is too high, then the Fed would need to tighten monetary policy to bring it back down to the level consistent with 4% nominal GDP growth. By targeting nominal GDP growth, the Fed is ignoring the past and basically saying, what do we need to do to get the economy growing going forward? Of course, there's still a problem of predicting what nominal GDP growth will be. The Fed uses economic models to forecast future economic conditions, and they make policy decisions based on that. But those models are limited by past data and simplifications. There are just too many variables to consider. The reason market monetarists have market in their name is their proposed solution to this problem: futures markets. A futures market is a place where people can bet on whether or not some future outcome will occur. By allowing lots of people to bet on something, the market is able to aggregate all the information everyone has into a single market price, just like it does for regular goods and services. Remember, a price is a signal wrapped up in an incentive. This sort of futures market could work any number of ways, but here's a pretty simple way to think about it. On this market, any person would be able to become a buyer or seller. Sellers offer a contract, and again, there are many different ways to set this up, but here's one. The contract says that the buyer will be paid X dollars, where X is 100 times the growth rate in nominal GDP over the next year. So, if nominal GDP grows by 4% over the next year, at the end of the year, the seller pays the buyer $400. So say the seller offers this contract for $300. That means they think the growth rate will be less than 3%. If they are right, the buyer will pay them $300, but they will only pay back something less than $300 in a year, thus making a profit. Of course, any buyer of this contract thinks the growth rate will be more than 3%. They will pay $300 now, but they think they will be getting something more than $300 in a year. It's a bet, a gamble. But if you let anyone join in buying or selling, you will attract experts who have some insight no one else has. A huge number of people, from bankers to investors to economists to corporations to individuals, will have information that might make them believe growth will be higher or lower than what is being offered. But all this supply of contracts offered will be balanced with all that demand, and the market will settle on a prevailing price for these contracts that reflects the combined wisdom of buyers and sellers. If the market price settles on $390, then the market is predicting a growth rate of 3.9%. What market monetarists propose is that the Federal Reserve abandon the federal funds rate as their target and instead set up one of these futures markets where they can then target the price of these contracts. When the futures price dips, it reflects a consensus that the economy will see a recession, and the Fed can ease monetary policy, print money, and buy bonds. And they will know when their actions are sufficient when these futures prices start to go up. If they go too far and the prices are too high, it means that the market expects too much inflation, and the Fed can slow its purchases until the price comes back down to their target. There's a huge amount of evidence that betting markets like this do better at predicting the future than any other method. When people are willing to put money on the line, that usually reflects genuine knowledge and not just posturing or wild guesses. And if the market is big enough and attracts enough participants, there's just no way to do better than to believe the market price. Market monetarism really started to gain acceptance when Bentley University professor Scott Sumner started a blog at the beginning of 2009 where he posted long screeds about how the Federal Reserve was blowing it. The thing was, his arguments made a lot of sense, and they matched the data as it slowly came out over the next few years. Within a couple years, Sumner had managed to convert a number of prominent economists of all political stripes to the idea of end GDP targeting, such as Christina Romer, Tyler Cohen, and Paul Krugman. And while the Fed did consider making the switch, they ended up going with the regime we covered in the other video. Nevertheless, market monetarists were successful in getting the Fed to be more forward-looking. In 2019, markets started to indicate that the economy might be headed for a recession. And seeing these forward-looking indicators, the Fed started to ease monetary policy. Indeed, some parts of the world experienced a downturn in the summer of 2019, but the US successfully avoided one, and market monetarists credit a Federal Reserve which was acting in a way consistent with their propositions. Unfortunately, monetary policy could not prevent the COVID-19 pandemic, which did end up sending the US economy into a recession. But it is worth noting that the period from 2009 to 2020 is the longest period of continuous economic expansion with no recession in US history. Not too bad.